We've been talking about the possibility of recession for what's felt like, a very, very long time.
Hey everyone, Dale Anderson, hope you're well. So today there's some important things I wanted to discuss. For quite some time now, economists have been warning about the possibility of an impending recession. However, it seems that the recession may now have been cancelled.
Wall Street remains braced for a recession, eventually. That's in part because consumers are poised to slow down their spending.
So why is this really important? Well, consumer spending makes up roughly 70% of the entire US economy, and it's currently slowing down, which typically indicates a recession. But this time it could be different.
I continue to think that it's possible that this time is really different. And the reason is there's just so much excess demand, really, in the labor market.
I mean, it's been amazing how resilient, in a way, the consumer has been to this inflationary shock.
You see, so consumers are still resilient because we have had to spend money on essentials regardless of inflation, making them more expensive.
The reality is that as prices are rising, the things that you have to pay for, the everyday expenses, your rent, your mortgage, your utilities, food, all of that is increasing and increasing dramatically in some cases.
So we have a divided economy with debates about whether the US consumers will slow down their spending enough to cause a recession. On one side, some economists argue that there's enough savings to shield people from price increases, which shouldn't trigger a recession.
Consumers still have the financial buffer. Even when spending is slowing, the process might be gradual because they still have money in their bank accounts.
When on the other hand, economists argue that the gross domestic product was low in Q1 of this year, and we could potentially see a negative growth in the next quarter, which would meet the definition of a technical recession. 2 consecutive negative GDP reports.
At the end of 2023's first quarter, gross domestic product grew at 1.1%. While not negative, this growth isn't strong enough to rule out the possibility of a recession. Something is occurring underneath the hood here. People are shifting what they buy.
So there is a shift happening in how consumers are spending their money. The big question is, if we slow down our spending enough to cause a recession, what will happen to the consumers and investors? So will the Federal Reserve step in to lower interest rates and stimulate the economy, or will they maintain the current interest rates to combat inflation?
The strong consumer spending may be keeping inflation hot. In March 2021, the headline inflation rate shot past the Federal Reserve's target of 2%. Fast forward to April 2023, and inflation remained close to 5% annually. The escalating prices are only just beginning to slow people down.
So in today's video, I want to share with you the latest information and data surrounding the economy and the ongoing recession conversation. But before we dive in, make sure to hit the like button, follow me for more news and insights, and let's get started. So as we've established, consumer spending is a crucial factor when determining the likelihood of a recession.
If consumer spending is strong, that alone is, generally speaking, enough to keep the economy from slipping into a recession.
If consumers continue to spend, we can avoid a recession. However, if consumer spending is influenced by 2 key factors: access to debt and number 2, incomes. You see, access to cheap debt is limited due to high interest rates ranging from now 5% to 5.25%. This naturally reduces consumer spending. Additionally, incomes play a significant role.
February 2023 survey, 4 out of 5 consumers said they were tightening budgets by buying less in bulk or shopping around more often for better deals. These sorts of micro decisions have a huge influence on the pace of economic growth.
I'm feeling it when it comes to food, which is so weird for me because I've never really concerned myself with how much food costs.
So according to the latest data from the Bureau of Labor Statistics, real income adjusted for inflation has increased by a slight 0.1% month on month. However, compared to last year, real income is down by 0.5% in April. Now let's take a closer look at consumer savings. The red line represents the trend, while the blue line represents actual savings. So during the height of the pandemic, savings peaked at around 33% thanks to stimulus measures. However, since Q4 of 2021, savings have declined below the trend line, reaching the lowest point in Q2 of 2022, coinciding with a peak of inflation at 9% in June 2022. Now, as inflation subsides, we can see gradual increases in the saving rate, but there's a catch. The things I do today for likes and subscribes. So the catch is that while higher income individuals show higher savings, those with lower incomes are most affected and resort to credit card debt.
Economists believe that people with less money may turn to credit to cover expenses in this economy.
I think it's really scary how much people are using credit to be able to afford what they need to have every day.
That sentiment shows up in this data set from the Bank of America Institute.
So let's take a closer look at credit card debt. This data reveals that individuals earning $50,000 or less are utilizing the highest amounts of credit card debt. It's crucial to examine how consumer spending is funded, as it helps us understand the potential impact of a recession on the average consumer. Are people spending money from their savings accounts, or are they actually borrowing to sustain their spending? So during the pandemic, government stimulus assistance meant people didn't have to rely on borrowing. However, as the stimulus measures phased out, the data shows an increase in borrowing.
That trend is starting to reverse. At the end of 2022, the average household had nearly $10,000 in credit card debt. Analysts believe that nationwide credit card debt may soon reach $1 trillion, an all-time high.
Putting everyday expenses on credit is so very dangerous because we know that as interest rates have been rising, so have rates on credit cards. So is the interest that you're paying on that money that you are indeed borrowing to pay for everyday expenses.
Now, this is arguably the worst time to borrow on credit, especially when interest rates have reached an all-time high of 20%.
Credit card interest rates have never been higher, topping 20% nationwide in February. These interest rates move up and down depending on the central bank's federal funds rate. And these rates are generally only charged to customers who carry a monthly balance.
By the way, there's a common misconception about credit card interest rates. The Federal Reserve does not directly set credit card interest rates based on the federal funds rate. Instead, we have a prime rate which is typically 3% above the federal funds rate. So while the federal funds rate currently stands between 5% and 5.25%, borrowing money through credit cards can result in rates above 20% due to the high risk associated with credit card debt. So overall, the prevalent theory suggests that a recession is highly unlikely in the second half of this year, primarily due to credit tightening. We've seen the consequences for regional banks that partied too hard and faced financial difficulties. As a result, banks have begun tightening their lending standards, reducing the availability of funds, and this will lower spending, leading to a decline in GDP, eventually resulting in a recession.
Other parts of the economy are flashing warning signs too.
There's been a lot of speculation since the recent failures of a couple of large banks. This could spark a reduction in credit.
You know, banks are becoming much more nervous. They've seen a bit of deposit flight in some of these small and regional banks. This combination of higher borrowing costs and reduced access to credit, this double pincer movement, if you like, on the household and the corporate sector of America is, I think, what could be really concerning and damaging for the growth prospects.
Interestingly, there are a couple of reasons why a recession might not occur. First, the labor market remains strong.
I think it's unlikely that we're currently in a recession, and probably the biggest reason for that is that the labor market is as strong as it is.
However, the real surprise lies in the housing market.
In the US, home prices have risen nationwide by more than 30% since 2020. Roughly 2/3 of US households own a home. Economists believe that these house price increases can amplify spending.
If you do in fact have equity in your home, you may potentially be in the market for a home equity line of credit. This is the ability to borrow against your home value.
So home values have increased significantly during the pandemic, building up equity for homeowners. This allows them to tap into their home equity through methods like home equity lines of credit, which can fuel consumer spending. However, borrowing against the house poses a risk, especially with fluctuating interest rates. So ultimately, it all comes down to one crucial factor: interest rates.
The Federal Reserve, for now, says those interest rates will stay higher for longer.
With today's action, we have raised interest rates by 5 percentage points in a little more than a year. We are seeing the effects of our policy tightening on demand. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation.
The truth about inflation is often misunderstood. While inflation may decrease, prices don't necessarily come down. Inflation measures the rate of price growth, so a decrease in inflation simply means prices are growing at a slower rate. This strain on people's savings and credit card debts will impact those without an emergency fund or cash cushion. Now, it's up to Jerome Powell and the Federal Reserve to decide whether to lower interest rates to combat a future recession or maintain higher rates to address inflation. On the other hand, the stock market anticipates interest rate reductions starting as early as November, supported by historical data showing that, on average, the Federal Reserve and the Bank of England start cutting rates 2 months after their final rate increase. With the last interest rate increase occurring in May, it's possible that we may see interest rates start to steadily decline later this year. Both the Federal Reserve and the Bank of England may not confirm this, but the data suggests it's a possibility. So if you're in the market for a purchase, you may benefit from lower interest rates later this year or next year. Personally, I don't try to sort of time the markets. Instead, I employ a strategy of dollar or pound cost averaging. However, understanding the market dynamics is essential. So I'd love to hear your thoughts on this because, in my opinion, the recession is not cancelled just yet. I do believe we're potentially heading for a recession, which will force the Federal Reserve and the Bank of England to reduce rates in the near future. But we must also consider the double-edged sword of inflation, which we hope will start to gradually come down later this year. I hope you found this information useful. If you did, please hit that share, like and subscribe button. I appreciate your support. Stay well, take care, and remember to follow me for more news and insights on property, finance, technology and market trends. Until next time, this is Dale Anderson signing off. All the best.